We are covering the 7 top actively traded stocks that are bullish today. While watching price actions, let us inform you. Our review on TSLA. Tesla Incorporated is still the undisputed king of EV hype. But lately, the stock has been stuck in a rough patch. The company's lineup, Model 3, YS, X Cybertruck and energy products like Powerwall and Megapack, keeps it at the forefront of clean energy and transportation. But recent sales trends have investors on edge. Today's 3.59% jump comes just ahead of Tesla's Q1 delivery report. But is this rally genuine optimism or just some last-minute hope before reality hits? Let's start with Italy, where Tesla's sales surged 51% in March, bouncing back from an ugly 54% drop in February. That's the kind of volatility that keeps investors on their toes. Despite the March rebound, Tesla's Q1 sales in Italy are still down 7% year-over-year, showing that the overall demand trend isn't as strong as bulls would like. Over in France, the situation is even worse. Tesla's March sales plunged 36.8%, contributing to a brutal 41.1% decline for Q1. And it's not just Tesla. The broader French auto market was down 7.8% for the quarter. But Tesla's numbers suggest it's underperforming even in a weak market. So what's happening? Some blame competition from Chinese EV brands, which are offering more features at lower prices. Others think Elon Musk's increasingly political persona is turning off some European consumers. Either way, the numbers don't lie. Tesla is struggling in key international markets. And that brings us to the big test, Tesla's Q1 delivery report. The data so far isn't promising. Deliveries in Europe are down 40%. China is down 14%, and even North America is down 3%. That's a decline across all major markets, which is why analysts are getting nervous. Tesla does have a few cards left to play. It's set to launch a more affordable model later this year, expected to come in under $30,000 with a $7,500 federal tax credit. If that car generates strong demand, it could turn things around. Meanwhile, the Model Y refresh is expected to give Tesla's best-selling vehicle a boost. But not everyone is convinced. Analysts at Wells Fargo aren't buying the bullish narrative, warning that Tesla has fewer levers to pull outside of price cuts and financing deals, which are already showing diminishing returns. And then there's the robotaxi gamble. Tesla has promised to launch its Austin Cybercab fleet by June. But if it fails to deliver, investors will see it as yet another overpromised, underdelivered moment. Right now, Tesla stock is a battleground. Bulls believe in long-term growth, while bears point to weakening fundamentals, increasing competition, and slower EV adoption. Wells Fargo still has an underweight sell rating with a $130 price target, implying Tesla is overvalued by 50%. Meanwhile, Wall Street's consensus is more neutral, with a hold rating and a $315 price target, suggesting some upside but no major breakout ahead. Bottom line, Tesla's Q1 delivery report is the next big catalyst. If the numbers surprise to the upside, today's rally could build momentum. But if deliveries come in below expectations, especially in an environment where EV demand is cooling, Tesla stock could be in for another rough ride. Our review on LCID. Lucid Group Incorporated is making waves in the EV space, and investors are paying attention. The company, known for its luxury electric sedans and soon-to-launch Gravity SUV, is seeing a notable surge in demand, especially from former Tesla owners. That's a significant shift, and the market is reacting, with LCID stock jumping 4.55% today. So what's driving this? According to interim CEO Mark Winterhoff, about 50% of Lucid's new orders in the past 2 months have come from ex-Tesla customers. That's a huge deal. Tesla drivers were always a prime target for Lucid since they're already comfortable with EVs, but this recent influx appears to be about more than just performance. Musk's growing political involvement has reportedly been a turnoff for some Tesla owners, with reports of Tesla properties even being vandalized in response to his controversial ties. This has led some Tesla drivers to jump ship, and Lucid is reaping the benefits. But it's not just Tesla's troubles that are working in Lucid's favor. The company has big ambitions for 2025. After producing 9,029 vehicles in 2024, Lucid is setting a bold target of 20,000 units this year. That's more than double last year's production, and it signals real confidence in its ability to scale up and meet rising demand. Unlike many competitors, Lucid builds everything in-house in Arizona, which helps with quality control and shields it from tariffs that could make its already high-end vehicles even more expensive. Of course, growth won't come without challenges. The EV market is shifting with slowing demand and increased pricing pressures. The upcoming Gravity SUV will be crucial. If it's a hit, Lucid could carve out a strong niche in the premium EV space. But scaling production while maintaining quality and managing costs will be a balancing act. Investors will also be watching to see if Lucid can improve its financials and reduce its cash burn, which remains a concern. For now, though, Tesla's missteps are playing right into Lucid's hands, and the stock is reflecting that optimism. If the company can keep up this momentum, it could be one of the more interesting EV stories to watch in 2025. Our review on HIMS. HIMS and Hers Health Incorporated is making some waves with a new strategic move that has investors taking notice. Known for its innovative telehealth platform that provides a range of health and wellness services, HIMS just announced it will begin offering branded versions of Eli Lilly's tirzepatide, which is marketed as Mounjaro for type 2 diabetes and Zepbound for obesity. This is a major drug that has been making headlines for its effectiveness in weight loss, and it's been a key driver in Eli Lilly's rise to being one of the most valuable pharmaceutical companies in the world. Naturally, the news sent HIMS stock up by 5.08% on the day. However, it's not all smooth sailing. While the stock surged, not everyone is convinced this is a game changer. Some analysts, including Alan Lutz from Bank of America, have expressed skepticism. Lutz argues that the financial impact of selling Zepbound may not be as big as people think. The reason? Eli Lilly offers Zepbound for around $500 per month, but HIMS is planning to sell it for a much higher price of $1,899 per month. That's a huge markup, and it could be hard for HIMS to convince customers to pay that premium when the same drug is readily available for a fraction of the price directly from Eli Lilly. Despite these concerns, HIMS is standing firm on its vision. The company sees this move as part of a larger strategy to build a comprehensive weight management platform, offering a variety of treatment options and personalized care for its customers. In addition to Zepbound, HIMS has also added liraglutide, another drug used for weight loss, though it's not as effective as Zepbound and has more potential side effects. Even with these additions, Bank of America isn't entirely sold on the potential. Lutz still holds an underperform rating on the stock and points out that even if HIMS successfully sells liraglutide, it may not significantly boost the company's financials. But on the flip side, if HIMS can make a dent in this space, particularly in getting consumers to embrace liraglutide despite its limitations, it could be a big win for the company and help solidify its brand as a major player in the weight management and telehealth market. Looking ahead, HIMS has set a goal to expand its offerings even further, aiming to establish a full suite of health solutions that can meet the diverse needs of consumers. That said, while the news is certainly exciting for HIMS, investors should remain cautious about the long-term financial effects. As of now, Bank of America's $22 price target implies a downward view of the stock, suggesting that even with these recent moves, there's still a lot of uncertainty around how profitable this new direction will be. So, while there's definitely potential for HIMS to carve out a larger niche in the health and wellness space, the actual financial impact of this new offering remains to be seen. Investors should keep an eye on how the market reacts and whether consumers are willing to pay the premium for HIMS weight loss drugs. especially when the same products are available from other sources at a much lower cost. Our review on RIVN. Rivian Automotive Incorporated, known for its electric vehicles like the R1T truck and R1S SUV, is making strategic moves that have caught investors' attention. The stock surged 6.67% recently, largely due to two key developments. First, Rivian announced it's spinning off its micromobility unit into a separate entity called Also, focused on electric bikes, scooters, and small vehicles. This move is designed to raise capital, which will help Rivian double down on its core EV business while still holding a stake in the micromobility space. Additionally, Rivian could be benefiting from Tesla's struggles in Europe. Tesla's sales have taken a hit, especially in markets like France and the Netherlands, where its vehicle sales fell by 37% and 61% year-over-year. Analysts believe Tesla's controversies, including CEO Elon Musk's political involvement, are damaging the brand's image. This creates an opening for Rivian to expand its footprint in the EV market, particularly in Europe. Despite the recent surge, Rivian's stock lags the market in some respects. The company's 0.32% daily gain fell short of the broader market's 0.55% gain, and while Rivian's month-to-month growth of 4.81% is positive, projections for its upcoming earnings aren't as optimistic. Rivian is expected to post a minus 32.77% drop in revenue, though it is still anticipated to see year-over-year revenue growth of 9.8%. Rivian currently holds a Zacks rank number 4, sell, signaling some caution from analysts. Rivian's spin-off of Also and Tesla's difficulties could provide the company with new opportunities, but investors should keep an eye on the upcoming earnings report to see how these strategic moves play out financially. Our review on RIG. Transocean Ltd, a leader in offshore drilling services, has been making waves recently with a solid 4.73% jump in stock price. This move comes as no surprise given the strong demand for their drilling services, which are crucial in the oil and gas sector. The company provides high-spec drilling rigs and work crews for offshore wells, which is key for oil and gas exploration in challenging environments like deep water and harsh climates. The stock's rise could be linked to broader trends in the energy market, particularly the ongoing recovery in oil prices and the increasing demand for offshore drilling. As Transocean continues to operate one of the most advanced and diversified fleets, this puts it in a favorable position to secure long-term contracts. Additionally, the company's 56 mobile offshore drilling units, including its floaters and jackups, provide it with the capability to tackle a wide range of projects in various exploration and development areas. While today's gain is encouraging, investors should keep an eye on how Transocean's contracts develop, especially in light of fluctuating oil prices and shifting market dynamics. The company's large, specialized fleet positions it well to handle high-demand projects, which could keep the momentum going in the right direction. Still, with any drilling services provider, the key will be sustained demand and the ability to secure profitable contracts. Our review on SMCI. Super Microcomputer Incorporated has been making headlines recently for its impressive 2.37% stock surge, which stands out in a market that's been pretty rough for the computer hardware sector. The company, known for providing high-performance IT solutions tailored to AI, cloud services, and edge computing, has managed to outperform many of its peers, including some big names in the S&P 500. A big part of this positive movement stems from leadership changes that investors seem to be responding well to. After a tough year, with some significant issues like accounting errors and a sudden departure of their auditor, Supermicro has brought in fresh blood to the board and senior leadership to help steer the company back on track. Scott Angel, an industry veteran with decades of experience in audit and risk management, was appointed as an independent director, while Itai Hu has a wealth of experience in corporate governance and intellectual property, was promoted to General Counsel. These changes aim to improve accountability and prevent any repeat mistakes, especially as the company's been working hard to address past concerns and get back in good standing with the SEC. For investors, this is a signal that Supermicro is serious about its future and getting its house in order. On top of these leadership updates, the company has been riding the wave of demand in the AI space, where they've been making major strides. Supermicro is well positioned to benefit from the growing interest in AI and high-performance computing, which could keep its momentum strong moving forward. While the retail market hasn't fully regained confidence in the tech sector yet, Supermicro seems to be on a path to restore trust and make an even bigger impact in the AI-driven future of computing. Our review on BBAI. BigBear.ai Holdings Incorporated has seen a solid 3.15% increase in its stock today, and there's a lot to unpack behind that rise. Known for its AI-powered decision intelligence solutions, BigBear.ai is diving deep into areas like national security, supply chain management, and digital identity, basically helping businesses and government agencies make smarter, data-driven decisions. The company's performance today reflects growing confidence in its ability to provide critical software and services that blend subject matter expertise with cutting-edge AI tech. BigBear.ai works across a range of sectors, from defense and intelligence to border protection and logistics, offering solutions that tackle complex problems like anomaly detection, predictive analytics, and cybersecurity. This rise in stock price also signals a positive market reaction to the company's ability to address pressing needs, particularly in a time when more businesses and governments are relying on AI to improve operational efficiency and reduce risks. With the public and private sectors leaning more into AI-driven solutions for better insights and smarter decision-making, BigBear.ai seems to be hitting the mark at just the right time. In short, the boost in stock reflects not only a solid day for the company, but also investor optimism about the future demand for AI-powered solutions, especially in areas that are critical to national security and global logistics. It's definitely a name to keep an eye on if you're looking at the intersection of AI, security, and operational efficiency. Please subscribe, give the video a like, and watch more from our playlist. Thanks.